Okay, hello everybody. Welcome to Korean Atlanta Mentorship. We're just going to do another Velocity Banking review. I don't know if you ever heard of the Built MasterCard, right? Built MasterCard. It's a credit card that allows you to pay rent. Okay. Now here's the crazy thing. Okay. So let's say you got a credit card that allows you to pay an expense that most people don't usually pay, which is rent, which is probably the most biggest expense, and it allows you to pay other things like food, gas, insurance. Now, what is the likelihood that when you have all your expenses built into one card, that you're going to put your entire paycheck into it, right? So the crazy thing is, and I don't know if the people who understand the people behind the card understand this, they're actually incentivizing the cardholder to do velocity banking, right? Because most people don't do velocity banking because their income is segregated. So when you put your entire rent plus all your other expenses on the credit card, that's essentially velocity banking because you're going to now put your entire paycheck into it. Okay. So if you've never heard of what's going on with the Built MasterCard right now, Wells Fargo, who's kind of managing the card, I think, is losing $10 million a month. Okay, $10 million a month. So it says right here, $120 million with Built MasterCard every year, and it's costing them a lot. So, do you think if they build a credit card that they didn't even know this probably that incentivizes velocity banking that doesn't allow them to accrue much interest, which is how they make money. And not only that, they gotta like do the maintenance and do all the credit card websites and build the infrastructure, which costs a lot of money. Do you think that that's something they'd like when they realize they're not going to make all the money, right? And that's why banks really don't like velocity banking. Okay, now here's the thing. I'm going to do a demonstration on velocity banking. And I've done many demonstrations, but if I were a bank and I realized, like, even on the 30-year mortgage, hey, I'm only getting, instead of getting $300,000 of interest, I'm only getting 20 grand over a couple of years, I'd be like, I don't even know what to do. I want to have the tallest buildings in North America or the downtowns in North America. And that's why I kind of wrote or made that clickbait thumbnail. Banks hate this because here's the thing. If you're losing 10 million a month, wouldn't you hate it too? You got a credit card that incentivizes this thing called velocity banking, and we're going to do a review of that today. So let me go ahead and switch gears now. So what is velocity banking? All it is a debt payoff strategy using a line of credit as your main operating account. We're going to make this really simple today, just one credit card. And maybe we can assume that this is the Built MasterCard, okay? Built MasterCard, we can use it to pay rent and all of our other stuff, and we have zero cash flow, okay? So we make $3,687.50, and this month our expenses are $3,687.50, okay? So first of all, what is velocity banking? All it is a debt payoff strategy using a line of credit, using your main line of credit as your main operating account. And a credit card fits into the definition of a line of credit because all a line of credit is a financial tool where you can borrow money, pay it back, and then use it over and over again. That's all a line of credit is. So, and a credit card fits that definition. Okay, so unlike the average American, where they just kind of rack up debt and then pay them separately and segregate their income, we're not going to segregate their income. We're going to do what the Built MasterCard wants us to do, which is put all of our expenses into one place and then put our entire paycheck into one place. Okay? So we assume two things when we do this. Number one, we have the same income. And instead of uh, having zero savings because we have no cash flow, we're always deliberately going to have zero savings throughout the time that we pay off our debt. Okay? So let's go ahead and do that. And now we're going to have something called cash flow, which is income minus expenses. Now we're going to increase our cash flow. I'm going to show you how to do that by making this our main operating account. So unlike most people where they just kind of pay the minimum payments of every debt that they have, especially with amortized loans, we're going to put our entire paycheck into that credit card. And because this credit card allows us to pay rent and we can also pay this all this other stuff, now we dump the entire paycheck in, right? That's why banks don't, they probably are going to learn their lesson and not incentivize you to pay rent with your credit card or your mortgage with your credit card, because you do that, right? Then you're doing velocity banking, and you could see that Wells Fargo is losing $10 million a month with a card that they probably didn't even know encouraged velocity banking. That's how crazy powerful the strategy is. $10 million a month from encouraging people to be responsible with their credit cards. Okay, all right. So let's go ahead and do this. And I screwed up here, so let me go ahead and so the available limit, we'll just say it's I don't know 16 grand. Okay, 16 grand, and the interest rate is I think it's 27%. And let me go ahead and shrink this, okay? So when we put our entire paycheck into that line of credit, does this monthly payment even matter anymore? No, it doesn't. That's how we increase our cash flow, right? We make this our main operating account and we increase our cash flow. So what we do is put our entire paycheck into a line of credit, expenses out, and then rinse and repeat over and over again and with some interest in there. So let's how much do we have here? This is 15K. So we're going to have a $15,000 balance. And then now we're going to just go ahead and do some calculations. Now, if we start out with zero cash flow and we don't have that much income, it's going to be a longer ride than usual, right? Usually, if you have a couple of debts and you start out with an extra $1,000 a month and you do this much better, it's amazing how if you just have an extra $1,000 a month, how quickly your debt gets paid off. Like it shaves off a couple of years, but it's no worries because we're starting out at zero cash flow and we're seeing how long, even with zero cash flow, we can take to pay off this credit card debt. And just a demonstration of using one credit card to pay off debt with zero cash flow. Okay, so now let's go ahead and calculate the interest. So we're going to go ahead and calculate the interest right here based on the average daily balance, right? Multiply it by the interest rate, which is going to be 27%, and then you divide by 12. Okay, so now let's go ahead and copy and paste this. So we're going to slowly chip away our debt. Again, we don't have that much income and we don't have any cash flow at all. And I frankly don't even think that most banks would even lend you this huge credit card at that income level, but I might be wrong. But so let's go ahead and do that. And we can see, okay, so we went from zero cash flow to to have it paid off in about 52 months, okay? So let's just go here and I'm going to do 52 divided by 12. That's about 4.3 years, right? So again, 15 grand at this stage of your life is probably a lot, but when you're at zero cash flow, it's going to be hard, right? So I personally don't think any credit card company would actually lend you a 15 grand credit card when you're only making 3 grand a month, but I might be wrong about that, right? But my point is this, okay? My point is that if you didn't understand the principle of putting your entire paycheck into that credit card, like the Built Mastercard encourages you to do, you probably be the bank would be extremely happy and because they'd be making a lot of money. But let's read that article again. But because we are doing this strategy, okay, because we're doing the strategy, and let me go ahead and switch windows, they're losing 10 million a month, right? 10 million. Look at this. Let me go ahead and zoom this in here. A new report suggests Wells Fargo might be losing 10 million a month with its partnership with Bell's Built Rewards Card, right? 10 million a month, 120 million a year, right? Think about that. You literally created a card to incentivize people to do what you did not want them to do, which is to segregate. Like you didn't want them to put their paycheck into that line of credit. You wanted them to segregate their income. But even then, because these banks are so big, they try to come up with new products and then don't realize what made them successful. You know what I mean? Happens a lot of times. Okay. All right. Well, just another quick velocity banking video before go to sleep. So have a great night, everybody, and we'll speak next time.